I'm Wendy Moran, an assurance partner at McGowen, Hurst, Clark & Smith. There is revenue recognition guidance that is new and effective for all non-public companies for years beginning after December 15, 2018. This new guidance requires a 5-step analysis of revenue and additional reporting disclosures. This video discusses step 3 of the model: allocate the transaction price to the performance obligations. Transaction price is the amount of consideration a company expects to receive in exchange for transferring goods or services. Issues affecting transaction price include variable consideration, significant financing, non-cash consideration, and consideration payable to a customer. Variable consideration exists if the amount of consideration is dependent on the occurrence or non-occurrence of a future event. Examples of variable consideration include discounts, rebates, refunds, volume discounts, price concessions, and right of return. If a contract contains variable consideration, any constraints related to that must be evaluated and met prior to revenue recognition. If a constraint is met, companies need to determine if the variable consideration should be included or excluded in the transaction price. Significant financing exists if there is a difference between the cash selling price and the contract price that represents a financing benefit. Revenue is bifurcated and analyzed separately between the cash selling price and interest income from that financing component. There is a practical expedient allowing companies not to bifurcate if the period between delivery and payment is 1 year or less. Non-cash consideration exists if there is a customer payment in a form other than cash. An example is a payment from a customer in equity. Measure the fair value of promised non-cash consideration at inception of the contract. Changes in the fair value of non-cash consideration are not included in the contract or transaction price. Rather, they are recognized as other income on the income statement. Consideration payable to a customer is cash that a company pays or expects to pay to a customer, or coupons or other types of credit that can be applied against amounts owed to the company. Treat as a reduction in revenue unless the payment to the customer is in exchange for a distinct good or service that the customer is transferring to the company. I hope you found this video helpful as you begin to evaluate the impact of the 3rd step of the new revenue recognition model. Please view our other videos on revenue recognition for additional details, or contact your accounting professional or us here at McGowen, Hurst, Clark & Smith for additional information or advice.